Hey, good morning, everyone. Eric Walters, Summit Hill Wealth Management. We are delighted to have you join us for our 2024 post-election analysis webinar. We'll let people kind of filter in. I know sometimes it takes a second for the system to get started. So again, thank you for joining us. I want to let you know I've got my colleague Jacob Boding joining me as co-host. As we go, love to hear questions. So there is a Q&A button on the bottom bar of your kind of Zoom. So if you want to type in Q&A at any time, do that. We'll pause, kind of answer questions as we go. So we'll get started. For those that haven't met Eric Walters, I'm the managing partner at Summit Hill Wealth Management. We're a boutique wealth management firm. We help families enjoy financial independence. And for us, that means aligning their money with what is most important to them so they can enjoy memories with the people that are most important to them. We do that through financial planning and portfolio management. And today we're going to talk about the U.S. elections. Now, there is some open questions about the U.S. elections. We're not sure exactly about the House. It seems to be, kind of firmly in Republican control, but I don't think we're here yet. But we can, we can talk about the White House. We can talk about Senate control, and we can also talk about the economy and stock market. So I'll get started. And here's our disclaimer. And here's what we're going to talk about. We're going to talk about first the overview of the economy and markets right now. The reason we're going to talk about that is because, new President-elect Trump is inheriting an economy and a market already in motion. It's almost like you can imagine a large steamer ship is kind of headed in one direction, and they're like, hey, change a captain. So if we want to change directions or make a move, there's already momentum going for this economy and market. So understand what is the current momentum. And then we'll understand Trump's policies and potential impact to the economy and the market. And then we'll end by talking about how stock markets have performed under different parties. Now, I do want to point out that I'm going to be focused on the economic and investment implications of policies. This is a nonpartisan webinar. But I appreciate that some of you are very, very excited about the result of the election, and some of you are not. I have friends that are like overjoyed at the results, and some that are talking about moving out of the United States. So I understand that you may be approaching this webinar from a different perspective, either maybe with enthusiasm or maybe dread, or I don't know. But I'm going to limit myself to focus on the economic and investment impact and stay neutral on, the shoulds, should someone have been elected or should, whatever. But I respect kind of wherever you're coming from. So before I talk about the economy and the markets, we have a poll, and I would love to hear from you. How do you feel about how the economy and the market is doing right now? So I'll ask my colleague Jacob to put up a question. You can kind of see, how do you feel about it, right? You feel great, you feel like, okay, not good, or it is terrible. So please take a moment for that pop-up and go ahead and give us your thoughts. I am dying to hear about how you feel, because I've heard a lot of different responses about how people feel about the economy. I think some people, if they're thinking about their personal, kind of cost, are thinking, yeah, things are expensive. Restaurants are expensive. Airline tickets are expensive. It's hard to share. So Jacob, if you want to go ahead and share the results. It looks like 33% of you, economy is great, 67 feel okay. Now, nobody responded with not good or terrible. That's really interesting. So at least kind of amongst, the people we have here, we get kind of great to okay, but at least everyone feels okay about the economy. And I would say, that's probably a good description of where we are. I certainly think the data does not indicate we are doing not great or terrible. And I'll explain why. So again, here's us, here's who we are, and here is kind of what we do. So this is us. Okay, so I want to show you just a chart that is just a visual representation of major economies around the world. And the chart is organized so that at kind of the one side is early when an economy comes out of a recession, they grow kind of rapidly. And this line is the rate of growth for an economy. So early on, after a recession, growth is, accelerating. And then in kind of mid-phase, growth peaks and then starts to slow down. There's not a recession yet. We're just growing more slowly. So growth might be at 3 or 4%, and then kind of be at 3 and then 2, and then in a recession, we're negative. So that's what this chart shows. It also shows the indicators that align with each phase. And so we started the year, and I think many people did, saying that the US was going to be in recession. Looked like the labor market was softening and more people were losing their jobs. We were concerned that growth was slowing at a number of companies. And, we just kind of weren't sure what was going to happen with the Federal Reserve and inflation. And if inflation continued to go up and the Fed kept interest rates high, that usually would slow growth. And we thought, might head towards recession. Well, after pretty much a year of data, the data shows that that's not what happened. But we actually had quite a strong year economically. And so we kind of moved our blue US dot back to in this mid phase, because we don't see growth slowing down. GDP growth is steady. We do not see, large kind of losses in unemployment. Maybe a little bit of softening, but you can't say that's a big, a big problem. And consumers are spending. Seems like as the rate of inflation is slowed and higher prices are higher, but at least more flat, people are more comfortable going out to eat, Broadway shows, movies, travel. Everyone's traveling. So that kind of consumer activity drives about 70% of our economy, and it's been strong all throughout the year. The last thing we'll say is manufacturing. Manufacturing is above, kind of growth trend. And in general, manufacturers are more careful. They're not going to kind of rev up production unless they have POs, purchase orders, or pretty good idea that demand is right. That's how they stay in business. Don't just create inventory for creating. So things are looking good. Now, on the campaign trail, Republicans would often say, this is, the worst economy and things are terrible. And I'm not making a political statement about, Republicans. They're saying what they're going to say. But I don't think that was based in data. The data, I don't think, supports that. And so you can see what we would be looking for is kind of slower GDP growth, slower earnings per share growth from companies, credit tightening from banks. We're not seeing that. Earnings under pressure, not seeing that. And the Fed raising interest rates to worry about inflation. We're not seeing that. The Fed lowered interest rates twice, right? Earlier this fall and then just yesterday. So the Fed is in this policy easing phase, and they're trying to achieve what they call a soft landing, right? They'd like this little bubble to avoid this red zone. Now that's pretty hard to do. If you're a skier, that's kind of like skiing down the slope, closing your eyes for 2 or 3 minutes and hope you don't hit any trees. You could maybe do it, but it's historically hard. And the reason why, before you get all over the Fed, is that the data they are looking at is lagged. And this is the Federal Reserve. They have the best data in the world, but their data is lagged. And the tool they are using to drive the bus has a lagged effect. So imagine if this was your car, you would be looking in the rearview mirror, and then every time you turn the steering wheel, it would take 2 minutes for the car to turn. Are you going to crash? There's a real chance, right? And so, like any of us, would I think quake to be in the Fed's position under that circumstance, right? Lagged data and lagged control, and only one tool, interest rates. And by the way, the only impact that they're looking for with higher interest rates is higher unemployment. So more people lose their jobs and spend less and drive down prices. Ugh. So that's the Federal Reserve's life. That's what they live in. They don't say it that way, but that's what they do. But they're trying to engineer the soft landing. So far, I think pretty well. But the main point is that the US economy is looking good. The momentum for incoming President-elect Trump is quite good. Now, he might say, this is all my doing, but presidents often get blamed for cycles that they didn't have anything to create. And then often, of course, they take credit for things that just happen. But it's human nature. But the economy is looking good. Now, of course, we should talk about the labor market. As I mentioned, it's looking good. Job openings have come down from a peak in 2022, but are still quite high. So that's good. We're also seeing the quit rate less. So employees are a little more skeptical about whether they could find a job. That makes it a little easier for employers. It shows maybe a little softness. But here's the one you should pay attention to: the layoff rate. The layoff rate is very low. It's below kind of long-term average. What does that mean? Companies are not laying off people. And if you just talk to business owners, in general, I don't hear them saying they're hiring a lot. I hear cautious. I also do not hear them saying they're laying off a lot of people. So the labor market is good. Now, we should mention inflation. Here's an interesting chart that shows just how much inflation increased, approximately 9%. You can see energy prices had a big part of that. I think that was a big part of why Republicans won. I think Democrats underestimated how pissed people are that everything's more expensive, right? And that Trump, to his credit, talked about it, right? So you can see not only has inflation gone down, but what gone down, and Trump picked up on this, that energy prices are down. This is usually kind of cost at the pump. Food at home, has also gone down in terms of the rate of inflation. So prices at the grocery store and, you can say just kind of more generally are kind of flat. And then dining, of course, everyone knows, like a $16 cocktail at a restaurant, that, has come down. Auto insurance has really spiked and stayed high, but it doesn't seem like it's going higher. And then shelter is also kind of moderating in the rate of price increase. We're not seeing price decreases, unfortunately, or fortunately, depending on how you look at it. But at least this rate is lower. So people are like, okay, it's still $16 at a cocktail, now 22, so we'll go up. But I think Trump picked up on the discontent about this, but from the Fed's perspective, it's heading in the right direction. Now, I should talk about, kind of the challenges. One of the challenges is the US fiscal position is questionable. I'll put it that way. And why? Because we have the largest primary budget deficit of not only developed countries, but also some like smaller countries where you normally would not put us, anywhere in the league of, like, let's say Greece, Ireland, Portugal. I mean, 2012, we thought those countries in particular were going to go like bankrupt, and they are actually doing okay from a budget standpoint. We have the worst. Now, this is just an annual budget deficit. I won't bore you with the charts that show the debts that are building up, but the market is starting to pick up on this. And I hear this from clients all the time. They're like, we don't like the debt. We don't like the deficit. And we have yet for this to kind of percolate up to our, elected officials and their wisdom. But the market is concerned about this because the more and more the US borrows, it does affect interest rates. And what it does is it pushes up interest rates. So there's this upward pressure on interest rates, which slows the economy. Now, is this going to affect us in the next year or so? Probably not. Over the next 5 to 10? Yeah, it will. And exactly how, I don't know. So this is one kind of like, not so great, right? And I heard a great analogy the other day that the United States is basically a big insurance company with the Army. And that's true because about 77% of the money we spent is on Medicaid, Medicare, Social Security. The rest is this little slot that includes defense spending. So if we want to talk about, the budget and all this stuff, it's like, don't talk about the Department of Education. We have this big, big pot we need to work on. And I'm not going to get into that now, but this is a challenge. And we'll talk about in a second when we talk about Trump policies, but this is a challenge. All right, now how do markets do after elections? Usually do pretty, how do markets do after the Fed lowers interest rates? They do pretty well. So not only is President Trump electing an economy that just has kind of nice forward motion, as they say in football, the trend is with 2 interest rate decreases, the market usually does pretty well. The on one side shows the return of the S&P 500 around the end of Fed hiking. This is before they start lowering. It's just we're not raising anymore. And you can see it's often up, not just a little bit, but maybe 20, 30, 50%. Yeah, so that's pretty good. Now you know why the stock market wants lower interest rates. It just booms everything. Even the bond market does well. If you know your bond, kind of math, as interest rates go down, bond prices go up. So that's a nice math there. So bonds don't go up as much, but they also do well. So President Trump and, kind of Republicans are kind of inheriting kind of, hey, you're on the 1 yard line, just don't screw it. We'll see what happens. But things are looking good from an economy standpoint and a market. So here's the data. If you're, kind of a data nerd like I am, here's, the data as of October. So we haven't even included the positive returns the last couple of days. You can see Chinese equities have, kind of flown up from losers last to doing really well because China wants to stimulate its economy. But year to date, like double-digit returns. So the market has been feeling positive about economic data. And as usually does happen, the day after an election, the market's like, well, we know what happened. So there's kind of a relief rally, which, certainly happened on Wednesday. Is that the market excited about Trump and Republicans? I don't know, but it's historically often happens the day after an election. It's kind of, it's one less thing to be uncertain about, and the market hates uncertainty. So the market's doing really well this year, and things look good for next year. So um, so I'll just end this discussion about the economy and the stock market and just provide context before we talk about Trump and his policies and what's looking forward. The base, it's kind of just like, hey, things are looking good. Now, if you are someone who's concerned about Trump's policies, one thing I'll say is that it's actually kind of hard to like steer a big economy like the US, even if you feel like their policies are really bad. It's like you crank that wheel for a while before you have a negative result. And if you think, Trump is a genius, that's great, but just realize, things are already heading in a good direction, and it'll be a little hard to differentiate like how much of this was already positive momentum and how much of this was, the Republicans' action. Okay, so we're going to talk about the result. But before I do, second poll question. I'm curious, how do you feel about the impact of Trump's policies as you understand? So here's the second question. And so do you think, the US elections for president, Congress, will it kind of maybe have an impact? Maybe it won't, maybe a major impact. What do you think? Give us your thoughts. So I'll let you have a discussion. By the way, while you're doing this, just to remind you, Q&A on the bottom. Let us know your questions. I love interactive nature of webinars. If you're like me, I kind of got burned out on webinars in COVID. They're just like wah, 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 so boring. So we're trying to make it more interesting, trying to be thoughtful about time. And then, let's hear about what everybody thinks. Okay, if we could go ahead and end this, Jacob, and we'll share the results. So, how do you feel US elections, Congress affect the stock market over time? So it seems like we're kind of evenly divided between it has a major impact and it depends, and then a small amount for in general, it's the same. So we'll have to wait and see. I'll show the data with you, but thank you for sharing your results. And I think all of these answers can be correct depending. So like any good student of economics, you say, well, it depends. So thanks for sharing your thoughts. Okay, so we'll talk about results. Unless you've been on Iraq, you already know President Trump won the White House. Republicans have retaken the Senate, and we're not sure on the final results of the House. Last time I checked, I could be wrong, but it looks as if it's probably going to be a red wave and take the House as well. Now, the question about the House is actually important because, if it's a sweep across, White House and Congress, theoretically, Republicans could kind of do whatever they want. And I always think, and I'm sure you think, that they'll get together in a room and say, hey, brothers and sisters, it's time for us to do everything we want. Let's go through and pass 25 bills. Let's reshape America. Let's do everything. And of course, what ends up happening is they end up fighting like cats and dogs. They usually do one piece of legislation, and then they kind of waste all the rest of their time. Independent voters vote in the other party in midterms, and this has happened consistently for the last 20 years. And I don't know, you would just think isn't this what you want? Isn't this what, apparently the country wants? But no, they're not going to likely do that if history is any guide. But if Republicans don't take the House, then of course it is kind of a break on presidential plans and hopes and dreams. So we'll have to wait and see, but it seems if it's trending towards Republicans at this moment. Okay, now we'll talk about Trump policies. I'm going to divide them into a few different pages. First one is going to be, trade policies. I think from an investment standpoint, we have to start here. And I call this the push-pull dynamic, meaning pushing could be positive, for the economy, and pulling could be kind of negative. We're not quite sure. This, as near as I can tell, is kind of the dynamic we should expect with Trump policies. If his first term is any indication, there is a real possibility that Trump may say a lot of stuff, and then what actually gets done, it's hard to know. There are, I think, some people, if they say, I'm going to do A, they are like a honey badger, and they will not let go. It is their thing. Trump, I think I would describe his style as more, kind of, I'm going to throw a lot against the wall and see what happens. And I'm often going to take a more extreme position, maybe for negotiating, maybe to scare people, maybe to, I don't know, and then maybe accomplish something, less than, and be like, hey, I did it. It was great. So, we'll see. But tariffs is probably number one in terms of economic. If you're not familiar with the tariff is, it's when the US government says, if you bring something into the US, you're going to have to pay us a tax on it. And so tariffs haven't been used notably for, over 100 years. In general, economists hate them because it creates friction and it lowers, kind of the free market vibe, as you will. Now, Trump did use tariffs in his first term against China. It was really started a trade war, and China was totally unprepared. And I'd say it kind of knocked China on its back, and that's one reason why Chinese growth slowed in 2018. They were not ready for this. Now they are, but still they have limited influence over it. And so he said that he could put tariffs as high as 60% on China and 10% on everybody else. Now, it doesn't take a PhD economist to figure out, if things coming into the United States cost more, could stimulate or be, beneficial to U.S. producers. And that was the promise on the campaign trail. Hey, we're going to favor U.S. producers, USA, USA. And those like baddies out there, like, And I'm not saying if that's right or wrong. It can work if there are U.S. producers that are to go. And the problem with saying, I'm just going to put tariff on 10% for everything is, the economists have a term called specialization. And that just means that if we're not that good at making cheap clothes, but they happen to be good in Bangladesh, we're not going to make any cheap clothes. But all of a sudden, if you put a 10% tariff on cheap clothes from Bangladesh, hello, Timu, then, theoretically, it should be, more favorable for US firms producing cheap clothes. But what if there aren't any? Then the US consumer, whether it's a company or individual, is going to pay more. And so that's the problem with tariffs. That's why economists are like, oh, like this is not a good tool. Just don't do it. Is it, is it going to play out the way he said? I'm not sure. I know he is serious about it, and it certainly was a major campaign tool. But isn't it a negotiating tactic? Is he going to walk out and say, hey, China 6%, and then walk away with 10 and be like, yeah, I got you? Or, I don't know. I mean, we'll have to wait and see. If it does, of course, so let's say he does put tariffs of 20% on China and then 10% on everybody else. Of course, what happens is if there is a producer, it will stimulate that US producer, right? Great. But for all the other places where there's a gap in the supply chain or that the company just isn't ready, it'll increase prices. And so I'm not saying if it's good or bad. You could be like, yeah, US, it doesn't matter if it's higher prices. Or you can be like, oh no, it's an imperfect tool. I'm not saying, but it again, push pull, right? The US producers could be like, yes, and if there's no US option, you're like, sorry, US company or consumer, you're just going to pay more. So this is why consistently, this is what Kamala Harris talked about, was his policies could lead to higher prices. And I don't know if he addressed that on the campaign trail. I didn't hear him say that. It's possible. The second thing he's talked about is deregulation. Talked about regulation kind of more broadly, but two things did come out in terms of banking, mergers and acquisitions, and oil production. So it's easy. I'll start with the last one, drill, baby, drill. I think he looked quite skeptically at, kind of green energy and is like, hey, we've got all the energy right here. He's right. We are already one of the top 3 oil producers in the world. And, you can make an argument that like, hey, we can just be energy independent. We don't need anybody else. So this could be stimulative over time to those industries, but immediately, the impact could be muted. I'll move on. I want to be thoughtful about time. All right, so domestic policy. Of course, the first one here is like the big one, right? Immigration. So if Trump is a big deal about, the loose border and the number of illegal immigrants that have come over in the last 4 years. The data does show that there was a amount of illegal immigration that happened. And depending on your political persuasion, you can be like, oh, it's not a big deal, or it's like an emergency. But it does seem like there was, a number of people coming across. And now Trump has said not only would he like to enact stricter border controls, close the border, but also to deport people. And he's talked about people with criminal background. And that, it's hard to get a feeling for that. I've seen data range from anywhere 500,000 people to maybe 1 million. It's kind of a fraught topic. I don't think he's going to get much pushback about that, right? You're like, yeah, they're illegal and they're a criminal. I think most people are like, yeah, let's get them out. But he's also said, I'll just deport everyone who's legal. It'd be 10 to 15 million people. That's quite a large number of people. And depending on how border controls are implemented and when, And when and how deportations happen, it's just going to reduce the labor. And some, if you're deporting criminals, you probably don't want them around anyways, but just more in general, the economic benefit of immigration is that it provides affordable labor. And immigrants, the data shows, do not commit crime at a higher rate. Sorry, that's not what the data shows. They pay taxes like sales tax and gas tax and all that, and they don't benefit from federal, benefits. So in general, it's like, wow, we get cheap labor, we contribute to our tax base, and they don't get benefits. Like, wow, this is great. Now, the social costs of immigration are real, right? They can, crowd out, demand for housing. They can crowd out low-cost jobs. And, people can feel alienated in their own community. Like, what the heck, I thought we were all speaking English. So that's the push-pull with immigration, right? And again, I'm not saying good or bad. I'm just trying to stay data focused. But if deportations happen in a big way, that's really going to constrict labor for a lot of companies, particularly construction. 30% of workers in construction are immigrants, and I'm sure a good number are illegal. And if you've ever tried to get a renovation on your house or build a building, it's already, kind of tough. And then imagine just taking away a bunch of their employees, their best tile guy, or their best concrete guy is now back in Honduras. What's that going to mean? So hard to know. I could see Trump saying, yeah, this is a big deal. And, we deported, so many immigrants, and maybe it's 600,000. And he says, well done. Maybe, the border is permanently closed, armed guards, and he deports 12 million people. I don't know, it's hard to know. I do know he takes it seriously, right? So I think we should as well. I won't spend much time on repealing incentives to the Green New Deal, except that he has talked about, kind of instantly repealing aspects of this. This was from the Inflation Reduction Act that President Biden signed into effect. It was, basically kind of providing a lot of incentives for renewable energy production, particularly manufacturing, to produce those, things that help with renewables. If he stops, basically a lot of those projects would stop. What's interesting is a lot of large oil and gas companies have said to President Trump privately, don't repeal this, because they have already started these multi-billion-dollar projects, and they feel it's good PR for them, at the very least, to be like, yeah, we're Chevron and we're renewable. And so they are like, hey, like, we want the tax benefit and it's good for us for PR. So like, don't just leave it. So that's really interesting dynamic. So he may back off. Maybe it was a good talking point, the campaign trail. And then maybe he's just like, oh yeah, okay, they actually want it. We'll have to wait and see. The good thing is that because we are such a large oil producer, if there's major military conflict in the Middle East, and likely it could be Israel and Iran, although thankfully at this moment it doesn't happen. But if it goes like hot war, then part of recent legislation allows the president to basically suspend all exports of oil and natural gas, and we would just be our own little bubble of oil production and consumption. And what would happen is the U.S. oil and natural gas price would completely decouple from the global price. We would be enjoying, like $50 or $60 barrel of oil. And, if there was a hot war where oil facilities and the Gulf were destroyed, like the global price of the barrel would be like $3. And you might say like, hey, yeah, we're supported. But if the global price of oil goes to $300, that's going to have an economic impact. So we pay less in energy, but still, like, that would be, but anyways, that's less of a detail, but I thought I'd bring it up in case Israel and Iran start shooting each other. All right, so the last thing I'll talk about in terms of policies is tax cuts. President Trump was very clear about tax cuts for everyone. And the way I understood this, that neither candidate was really clear about their specifics. And so, some candidates are more clear and others less. But he has advocated keeping the tax rates the same from the Tax Cut and Jobs Act that he signed in 2016, 2017. Now, you may know these tax rates are set to go up at the end of 2025. And President Trump has said, want to keep them the same for everybody. And Vice President Harris said, well, we want to keep them the same for everybody, except for those that earn more than 400,000. And, that was her policy. And it, clearly didn't sway people. Now, if they kind of roll over and keep tax rates the same or even lower them, and I have heard about kind of a grab bag of potential other tax cuts that Trump has kind of mentioned. If that happens, then yeah, it just increases the annual deficit and it just adds to the national debt. So, tax cuts in short term are stimulative. I already talked about the national annual debt, the national debt. Long term, that is, leads to a major recession and or, kind of a multi-year, kind of malaise like the 1970s. So, in general, you're like, yeah, my analogy is like, how many times do you want to give like a 4-year-old like a thing of ice cream? Like once, great. Every day, maybe it's a lot. 5 times a day, like probably a little much. And that is kind of how tax work. It's just like sugar in the system. And is that good? You're like, that was yummy. Is it nutritious? You look at the bigger picture. The bigger picture is our fiscal position needs to be dealt with. And we just have politicians, and I think voters are like, la, 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 la. I'm not going to talk about it. So tax cuts in the near term, and near term meaning kind of 1 to 4 years, are pretty stimulative for the economy and the stock market. Longer term, some concerns. The last thing I'll mention is Trump has said that he would, kind of potentially fire Jerome Powell, the chairman of the Federal Reserve. He wants the Federal Reserve to report to the president that he thinks he should have, kind of an influence in the stay. This is not new. Presidents have done this. Lyndon Johnson browbeat the Federal Reserve chairman. Most notably, Richard Nixon was really cozy with the chairman of the Federal Reserve, Burns. And in general, this is a really bad idea because if you are a politician, you want interest rates to go a certain way to benefit your party, and if you're an economist, you're like, look, we want to be balanced here. And the Federal Reserve is supposed to aim for maximum unemployment, which is low unemployment, and moderate rates. That's their two mandates. If you start, kind of jacking around with the political considerations, in general, politicians don't understand this. They don't think long term. And that's what happened in the 1970s. Richard Nixon pressured the Federal Reserve under Burns to keep interest rates low. And so what happened is, interest moved up, inflation moved up, and the Federal Reserve raised interest rates. And then Nixon's like, hey, higher interest rates stink, lower them. And they lowered them too early. And then inflation shot up way high. And then it was, kind of a terrible decade. That's the risk. Now, you may know yesterday Jerome Powell was asked, would you step down if President Trump asked you to? He said, no, the law doesn't allow it. So Powell is aware of that threat and not ready to step down. We'll have to see how that plays out. I am going to spend a moment and talk just a little bit about the Federal Reserve because this is major influence of policy and the economy and the stock market and bond market. So I think the Federal Reserve is haunted by ghosts of Federal Reserve past. And, like this is the Dickens novel, right? And so, we all love Greek tragedies, or historically, everyone's loved Greek tragedies because there's something so human about human trying to do the right thing, but they have this like one character flaw and they just can't get over it, right? They're proud or they're afraid. And we just see this happening. You're like, oh no, don't do it again. Like, please, So the Federal Reserve has made two big mistakes in its history, and it kind of haunts Federal Reserve governors and chairmen. The first one was allowing the banking system to collapse in the 1930s. Just kind of stood by and was like, well, we got to clear out the system. That made the Great Depression significantly worse, right? The second mistake was in the 1970s. As I mentioned, inflation increased. The Federal Reserve did what it should, which is raise interest rates to slow down the economy. But under pressure from President Nixon, the chairman at the time, Burns, lowered them too quickly. And inflation shot up, and not in a small way. And then it was persistent for years. And then the Federal Reserve was, hesitant to lower them and kind of half measures and, just being, just not on the ball. And so these two things haunt the Federal Reserve. The first one happened again almost in 2008. The banking system almost collapsed in 2008. So if you are wondering why the Federal Reserve completely freaked out with quantitative easing and rescuing banks, it's because they're like, we can't let the 1930s happen. Right now, the Federal Reserve realized we got inflation wrong in 2022, or excuse me, 2022. 2021, if you remember, after COVID, the economy was roaring, the stock market's heading up, and people were like, hey, Federal Reserve, aren't you worried that this might lead to inflation? They're like, no, 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 no. It doesn't matter how much money Congress has pumped in. It doesn't matter how much money we've pumped in. After 2008, we did the same thing, and it didn't lead to inflation. And then the Federal Reserve got nailed in 2022, being not a little wrong, but a lot wrong. Inflation roared back to 9% in 2022. The Federal Reserve looked like a complete idiot. So here we have the exact same setup in the 1970s. The Federal Reserve is like, oh, wow, inflation's really high. We have to raise rates. Did they raise them slowly? No, they raised them very quickly, right? Put us into a difficult economy and, stock market in, 2022 and into 2023. And then you can bet, President Biden would have loved the Federal Reserve to lower interest rates to make everything look rosy before, the election. To his credit, he didn't, attack the Federal Reserve publicly. I got to give him credit. That's just a nice, class act there. But, but Powell is a human, and there's two people he's thinking about. Now, he could go out as a Burns if he lowers rates too quickly and inflation spikes. Everyone's going to say, you're a loser. You just did what Burns did in the 70s. I'm sure you bowed to political pressure under Trump. You're a terrible, terrible economist. He does not want to do that. He wants to be a Volcker. Volcker was our economic savior in the early 80s. He killed inflation by running interest rates higher than they've ever been. We're talking like 14, 15, 16%. Now, I don't think the Federal Reserve is going to raise that rates that high, but you can bet Powell is like, hey, well, I'm not going to make that mistake. So, and if that's all you need to know about how Powell talks and about what he says and why they're going slow and everything. It's the ghost of Federal Reserve's past. Now you've got President Trump talking about tariffs, possibly inflationary, immigration, deportation, possibly inflationary, and then you've got Trump saying, I want to, talk about, you should report. Powell's like, 5 alarm fire. He's like, wait, this would all be inflationary. You could screw up all of the like gentle kind of soft landing. So you can see Powell's like, I'm not going to step down. I'm not going to let you ruin this. My interpretation. I don't know what he's really thinking, but that's my guess. So the Fed, of course, is really. All right, I've already talked about the key issue. If you want to see the data here, this is the current 2023 and 2024 tax rates. And then what would they be if the Tax Cut and Jobs Act expires? Now, with President Trump and the Senate and likely the House in Republican control, I highly doubt they're going to let tax rates go up. I mean, they've all said, yeah, keep them, roll it over the next 10 years. Now, you may know under congressional rules, if you lower taxes and you don't offset that and create revenue, your tax cuts can only last 10 years, which is why the Tax Cut and Jobs Act expire. So that's what they'd have to do. They'd have to kind of punt it down and say, well, yeah, we're just going to increase deficits. So let's see what happens. Okay. So here's the summary. And I heard this the other day and I love it. This is a great phrase. Take Trump seriously, but not literally. I think that would be a takeaway from maybe his style, his first term. Him seriously, the things he said, I think he will pay attention to, but not literally. Is he literally going to put 60% tariffs on all Chinese goods? I don't know. Seems like it could be, a negotiating tactic. So I think equities are going to be supported, means I think they're going to be flat to up, probably up. Things look pretty. Inflation interest rates could in longer term, to see about, of course, immigration. We'll have to see about tariffs. U.S. oil production is probably likely going to go up. And if you're in that area, you're probably going to experience, faster permitting times. So that's positive for banking and energy. And now Trump did mention cryptocurrencies. That was kind of a late, kind of thing. Is he really going to do it? I don't know. I mean, what does that mean? I like crypto. I don't know. Now the Federal Reserve is working on a crypto-based, dollar, because the Federal Reserve Treasury officials do not want crypto to expand. Why? Do they hate blockchain? Do they hate crypto? No, they realize a vast majority of crypto exchanges are by criminal enterprises and terrorists. And the data kind of bears that out. It's completely unchecked, market, movement of money. And so I think they're saying, hey, if we could like a Fed dollar or a Treasury dollar, it's crypto, then it still goes through our system. It still is electronic. Maybe Trump will embrace that, but I don't think Trump's enthusiasm or so-called enthusiasm has anything to do with Bitcoin. I don't know. We're neutral on U.S. Treasuries just because we don't think interest rates will drop. If they were, the value of Treasuries would go up, and we'd want to lock in interest rates now, but neutral on them. I don't see interest rates dropping really rapidly. And as I mentioned, I think interest rates is higher for longer. I think Powell's going to be cautious. That's, stock market. That's, economy under Trump. Okay, now I'm going to pivot to the last part, which is, what should you expect as an investor? How have things performed historically? Now, the down market ballot, kind of does matter as it relates to how the S&P as a proxy for stock markets have performed. In general, if you got a Republican president or a divided or Republican, Congress, in general, it's pretty good. Now, if there's opposition in Congress, it's not as good. Interestingly enough, historically, Democrat presidents kind of work with Republican Congresses, but at least historically, that hasn't happened. Now, it's a small data set, so you can't draw big conclusions. But anyways, in general, stock market's gone up under this scenario. Now it does exclude 2001 and 2020 and 2002. That was a more interesting market with the tech crash. But in general, it looks good. Now there is something called the presidential election cycle. And so this chart just shows how did the stock market perform the November of the election for the following 12 months. Not exactly the calendar year, it's backed up a little bit. In the first 12 months after an election, positive. And why is that? Because, for quite a long time, whoever is elected often gets a sweep of Congress, and they often get like one or two pieces of legislation. And lately, it hasn't been bad news for taxpayers and, the economy. It's either been tax cuts or more government spending. And even if government spending is like dumb, it still puts cash in the system, which eventually trickles down to businesses. So even if it's like dumb government spending, it still is like stimulative. Now, the problem is it can create deficits and debts, which we have. But still, often in the first 12 months, they're like, hey, voters, here's some more, and by hook or by crook. Year two is usually modestly positive. Years three is usually the strongest because usually elected leaders are like, hey, we got to get ready for the next election and let's do something. And then the pre-election year is often positive, but it can be a big swing. So if you're just like, I don't know what happened in the election, historically, the 12 months afterwards are positive. All right. Now, for those of you that are feeling really, really positive about this election or really negative, and you might think, I got to change my portfolio. That's it. I got to go all crypto, all equity, or like it's cash and I'm like fleeing to New Zealand. That's not what the data is. The data shows that elections are really, really important for social, political, moral issues, but that you shouldn't invest that way. Because if you even look recent, last 12 years or so, if you only invested in a certain party, you've had a little bit of money, but you got a lot more if you just stay invested. And then if you take that thinking back to the last 70 years or so, and you just stayed invested, you had like $2 million versus going in and out for the political party. So I like to say, vote, but don't invest your vote, right? So we're not gonna apply that. Now you might think, well, my team is good for the economy and the other team's terrible. Well, the data shows. If you look back to the 50s, kind of if you look at the growth rate over 4 years of a given president, actually you could say, two Republicans have, negatives and Democrats don't. But again, it's a small data set. And if you look at in the middle, the compound annual growth rate is almost identical. And so and I didn't show you, but the GDP data is almost the same. So why would that be? It's because economic cycles don't happen within 4 years, and presidents and Congress usually can't get their act together to do anything. And so more often than not, it's kind of logjam. And so more often than not, the economic cycles kind of move on like the tide, and sometimes lines with an election, sometimes it looks good, but often it's just kind of by accident. And that, to me, that's just kind of what the history shows. Again, this isn't a political statement where you're red or blue. It's just, I think, just reality. It's just the way it is. All right, we'll wrap it up and then we're going to address questions. So again, if you're like, I'd love to hear your question. We just have maybe 1 or 2 slides. This is one of my favorite all-time slides. If you were to limit me to only 1 slide to talk to someone about investing, it would be this slide. Why? Because this is taking $1 and investing it in the global stock market, not even the US, back in the 1970s. Now, if you remember what I said, the 1970s were terrible for stocks. Nixon is, pressuring Burns. Burns is like screwing up with inflation. Inflation is raging. Equities were doing bad. Like gold is flourishing. I mean, oh man, bad time. And look at all the other bad stuff that's happened, right? Market crashes, Iraq is invading, Russian, collapse, and of course, 2000, the tech crash, and then let's not forget 2008, and then the little thing called COVID, right? And through it all, your dollar became $80. So if this isn't the proof statement that we should not be hopping around, in our investments based on whoever's in the White House, or, whether we like the Federal Reserve Chairman, or, even if there's a war, whatever, just let your dollar go up 80 times, is kind of my number one takeaway. And it doesn't mean you should only be invested in equities, but the long-term view really works well. Now, it doesn't mean you never take action. It doesn't mean you never get defensive. It doesn't mean you don't, look at equities and say, they're getting expensive. That's not the message. But what I mean is, sometimes I hear from people like, I think I want to get out of equities, or, it's time to go into real estate. And they often are indicating, like with everything, or a majority of their portfolio, that's history would say, no, 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 no. Figure out the right mix of assets for your goals, your risk tolerance, and explore opportunities to be tactical, and assets that can enhance returns or protect you on the downside. That's what we do. That's important. But don't try to play checkers with a stock market that's playing chess. And often this kind of reductionistic, like, I like the team in the White House and I think things are good, so I'm going to go in. That's a checkers mindset when the market is chess. And the market at one already priced it in. They were thinking about 12 months ago. Two, the market is thinking way, way, way more complex than you are. And three, the market's comprised of tens of millions of investors that in aggregate are probably smarter than all of us. So just use it, just ride that. I'll get off my soapbox here. So kind of the key takeaway is, I think this should come together for clients in your financial plan. What does this mean for you? You are not in the White House. You are not directly affected by tariffs. I mean, maybe your business is. What matters to you is your lifestyle and your goals. That's where you start. Start with what you love. Start with when you'd like to retire. Or if you're retired, what is a dream retirement for you? Look at that. That's what's important to you. Whether you're up on the S&P 500 or down over 6 months, you can't eat your returns, literally, but you can spend time with your kids. You can take your grandkids to Disneyland. You can take up that hobby. You can learn French. You can move to a country. You can do all these things, right? Go play pickleball every day. That's, what makes a beautiful life, right? Go have coffee with your friends. Put a dollar value on that, build a budget, build a financial plan. If you're not working with someone, we'll help you build it. And we'll give you this probability of success. We'll tell you how to invest. We'll help you keep your eyes on the long term. That's how you interpret this. Now, if there's an increase in taxes, if there's raging inflation, I think a good advisor should make adjustments to your portfolio. Yeah, that's just kind of what we do, right? It's like an airline pilot flying into a thunderstorm. Like, try to divert, right? Build a financial plan, create a model for it. Okay, we've got some time. I'd love to hear questions. And so, Jacob, I'll kind of open it up. If you could let me know any questions that come up, I'll try to see if I can pick it up as well.
Yes, we got two questions that came in.
Thanks, go ahead.
The first one, I'd like you to comment on equities versus bonds portfolio positioning thoughts from traditional 100 age percentage distribution in a potentially inflationary policy environment with tariffs and deficit spending, etc.
Got it. So the question is kind of the relative value between those two assets, equities and bonds. Did I get it right?
I believe so.
Okay. So as I've said, I think, the policy are, the proposed policies are in general pretty favorable for equities. He's not talking about significant tax cuts. He's not talking about cutting government spending. He's not, kind of pursuing investments in projects that will cost money and pay off years from now. He's talking about tax cuts, which is stimulative. And then, tariffs, kind of hard to know. But in general, especially given the momentum, I would say we're overrated equities, and I'd say it looks pretty good. Bonds, the purpose of bonds is safe money. You lend money to the US government for treasuries or a local municipality in the form of munis. You get paid, some interest, and then they pay you back. So it's safe money. And so, I often am kind of hesitant to kind of go into bonds. I'm always like, well, this is kind of safe money and we want it for retirement spending or other, kind of, but I'm neutral on bonds. Just because interest rates may stay somewhat high because inflation may stay a little bit higher than anyone would like, meaning it's not going to get down to 2%. So I would be overweight equities. I'd be neutral on bonds. I would have enough for you, but I wouldn't suddenly pile into bonds. If that makes sense. Jacob, next question.
Yeah, next one's going to be, can you talk about how Trump's immigration policy, which could remove 15 to 35 million people, will cost America billions of dollars, and how this will affect the economy?
Sure. So let's say Trump, not only serious about deporting all illegals, but he did it, right? Let's say he does it. He deports 12 million, 15 million, 20 million. It's hard to know, right? What number that would be. Well, and from a domestic standpoint, it'd be chaos. I mean, are you gonna break up families? Are you gonna put them in like holding camps? Like what are you gonna do? And how are we gonna get them? Like you're gonna fly them all? Like so there's a lot of logistical problems that are not, minor. And then do we even have law enforcement to do this, right? You just think in general, law enforcement is a pretty small percentage of the population. And if we get a large number of people together and they just say, we're not going to follow law enforcement, that's called a riot. And usually the police are like, we got to retreat. So do we even have law enforcement? Is this like the National Guard? Are we going to like build a camp? Like, I don't know. So logistically there is, and I think it's not small issues. Like, how would you actually do that? Let's say he does it, like he figures it out logistically and whatever happens, with riots or whatever, we're just, 12, 15, 20 million people are just gone, right? There's not in the working place. That has an immediate impact on all of those restaurants, all those construction firms, all those, people who are hiring them to help with jobs. And, many of them are running businesses. I have talked to business owners who are illegal and running businesses. I didn't inquire about, how do you do this? What do you do? But one of them was running a cleaning business, and she, very smart entrepreneur. It was a multi-million-dollar business, and she was an illegal immigrant. So yeah, she gets rounded up, boom, gone. All those jobs gone. And am I saying it's a bad policy? This is not a political discussion. I'm just trying to walk you through what happens like the day after this happens, right? There's people are gone. Those are workers. Those are husbands and wives. Those are consumers. Those are people that go to, like your local restaurant. Those are people that, want to go to a Broncos games. So you lose workers, you lose consumers. And would that immediately make an opening for someone to open a cleaning business in the case of that one female entrepreneur? Yeah, you have one less competitor. Maybe that would work. Does that create an opening for someone to do the dishes or, kind of help out or, work on that construction firm and, kind of lay tile? Yeah. Is there an American worker immediately behind them say, I'm ready to lay tile and it's just that person in front of me that's in my way and you take that person out of the way and boom, I'm slotting in. In general, the labor market is not that finely tuned where if you remove 20 million people and their skills and experience, we don't have 20 million people that are perfectly aligned and synced with their experience and skills. It's just, why would you? That would just be a large number of unemployed people. So if you just deduct all these people and their experience and their spending, businesses would struggle, right? Depending on the business, all of a sudden your consumers are gone. But then also companies that just their foreman or their towel guy or or their entrepreneur or whatever. It's just we don't have people behind them that just says, oh, thank you. I'm just going to step in and I'll take over that contract and I'll fulfill that. So there'd be major disruption to businesses and their employees, major a lot of businesses and their consumers. The marketplace for labor would just be all crazy. I would expect that job postings would soar. I would expect that companies would delay projects, that you would get a lot of like COVID style, like, I don't know, like if you're run a construction firm and like half of your team is gone, I'd be like, I can't fulfill this, or it's going to take me a year instead of 3 months. I mean, I'm just imagining if you're running a manufacturing firm or a slaughterhouse and like 20% of people are gone, what does that do? It just drives up prices, slows down production. So again, this is not a political statement. I'm saying this is bad. I'm just trying to walk through like practically what would happen. So that's my take. If that does happen, that's why I think it could be inflationary, why it could be disruptive. Now, let's say we get through that, right? There's not 20 million people, but maybe that attracts people to become a tile and and then, okay, yes, we have a dynamic market. And over time, you could have Americans theoretically move into those slots. Now, the data shows a lot of Americans do not want the jobs that immigrants are doing. That's just the data. Do you have a lot of people that want to wash dishes at a restaurant? Doesn't seem like it. Do you have a lot of people that are just dying to clean houses or work in commercial cleaning services? Nope. That's just, do you have a lot of people that are gonna, rent a car and drive Uber and DoorDash? Don't think so. Now, and I don't mean to say these are the only jobs that illegal immigrants do. Please don't get me wrong, but that's often the jobs. And so not only do you need people to fill that jobs, but historically, you just, so then if you're a business owner and you're paying people under the table who are illegal, what do? You got to pay more and you got to talk to, American. And Americans are like, well, I want Christmas off and I need paid family medical leave. And, what's your healthcare policy? And if you're a business owner, you're like, wow, this is a lot cheaper when I hire illegal. Was that illegal for a business owner to do? And I'm not condoning that. I'm just saying if you do switch to like a completely legal workforce, that's not cheap. And you may or may not be able to find people. And so your business could stagnate. You could have to pay significantly more. You may not be competitive on your bids. You're just maybe contracting. You might get sick of it and say, forget this, I'm selling the company. I'm out. So it's a sensitive topic because the social cost of immigration can be really well known, right? But the economic benefits of immigration are well known. And that's a tension. So I'm here to resolve that, but that's why I think it could be a challenge. All right, good question. Next question.
Yeah, the last one we have lined up is how can we protect our portfolios against possibility of inflation?
Great question. Great question. So in general, inflation tends to spike and catch everyone by surprise. And we saw this in 2022. The stock market was like, whoa, 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 wow, the Fed got it wrong. Stocks were down about 20% that year, but since then have roared back with good Fed policy. So that's the first lesson. Stocks, paradoxically, are one of the best hedges against inflation. Now, if you think about this, you can kind of understand because let's talk about diapers, right? So Pampers, makes diapers. Let's say they're cotton and plastic and employees all get more expensive, as they probably did in 2021, 2022. Diapers, I believe, are 50% more expensive. So what do? They eventually they pass on the cost. So the stock of Pampers would go down. Investors would say, oh, Pampers, your input costs are higher. Your profits are going to be down for a year or two. And if you're the CEO of Pampers, you're like, well, yeah, but we're gonna pass this on. So just give us a year. And that's what they did. And then now they build back their profit margins, and then consumers are stuck with 50% higher Pampers, right? But this is how companies operate. And if you aggregate and multiply that over like the 9,000 or so larger publicly traded companies around the world, these are for-profit companies. This is what they do. If they don't do this, the stock market punishes them with a lower price and they go bankrupt if they don't figure it out. So actually, equities are a great hedge. Even you have to go through that dip, but equities are great because they hedge and they get a return above inflation. That's called the equity premium. That's kind of above risk or above inflation. Bonds don't handle inflation so well. So what we do on the bond side is we usually only hold what we need for your financial plan. And then we like to own individual bonds and usually a little bit shorter maturities. And then we also avoid, like high yield and kind of more questionable bonds. There's a lot of enthusiasm about packaged bonds right now called collateral loan obligations and private credit. If inflation hits hard, that's going to pressure a lot of companies and they may struggle to make those interest payments. And so I'm not overweight bonds. So I like managed futures. And now this is an institutional asset class. You're not familiar with it. They trade a trend in the stock market. And I won't bore you with the details, but we use one managed futures manager that is a rock star, an incredibly conservative, careful strategy. They actually go up when the stock market goes up, and they have consistently returned between like 5 and 8% per year with no correlation or reaction to interest rates or inflation. So, wow, 5 to 8% with no like downside on, wow. I'm like, that's like an investment manager's dream. If you're me and thinking, how can we get a risk adjusted return? Like, oh my gosh, this is amazing. So I have been moving assets away from bonds into this managed futures because these guys are rock solid. Now, they're never going to give you like an 11 or 15 or 20% return like stocks did the last 12 months, But for the safe part of your portfolio, I'd much rather be in a managed futures manager with no connection to inflation or interest rate movements than, going overweight bonds. So that's my.
Okay, we had another question come in.
Okay. Right.
How
And this
would
will be our
repeat?
last one.
Yeah, how would repealing the Affordable Care Act affect the economy?
Hmm. That's an interesting question. Huh. So let's back up. So the Affordable Care Act was interesting because it was time delayed in its implementation. But eventually what it created was, this idea of a mandate that either you had to be covered by an employer or, get your own coverage. That eventually was challenged, kind of struck down. It did create public marketplaces, which I believe have been really helpful for people who are starting a business or aren't offered health insurance. And if you repeal it, I'm not sure it would actually have a big impact. The reason why is that Republicans have been going after it for quite some time and managed to peel off the mandate. And I'm not sure it would have a major impact. You may remove some support for the, I believe, state-run open marketplaces, so that could become more expensive. You could have some insurance companies that are like, all right, finally, let's get out of here. And that could be one impact if, the kind of guaranteed insurability was removed, then you could have a lot of people uninsured. I'm speculating here. I'm kind of just talking out loud on the fly. So if the guaranteed insurability was removed, you'd have a lot more people that wouldn't get insurance. Additionally, that would just kind of lead to more maybe visits to emergency rooms and more burdens on Medicare, or excuse me, Medicaid, and Medicare. It shouldn't affect Medicare. So I think it made a huge impact, but I think it could be kind of negative. I'm not saying don't repeal it. I'm just saying that's my guess. So that's all the time we have for questions. We're just at the top of the hour. I want to thank everyone for joining. Thank you for your questions. Thanks for participating in our polls. If you have concerns, I am happy to chat about it. We're happy to share a copy of our slides. And if you want to talk about what this slide is showing, which is what's this mean for me? How do I make sure I'm protected from inflation? Kind of potentially, higher or lower taxes, contact us. We're happy to talk to you about it. So thank you so much and stay safe.